Here's a question I ask all the time. If you have $1 million invested, where and what is it invested in? The tax system in Canada doesn't look at a number on a statement. It tries to ensure that every dollar flows through the tax system. CRA wants their pound of flesh. Think of your account as a funnel. The same number on the top, pour it in, different levels of filters before you get personal dollars in your pocket to spend. One account has a filter that treats everything as 100% taxable income. Another filter only taxes the gain that you've realized in that account. And another, corporate, has many filters before it reaches your personal pocket. Let's set the scene. We're in Alberta. We will use Alberta tax rates. Let's also assume that we're taking the full $1 million out of each of these accounts. And for the non-registered and the corporation, let's assume there's a cost base of $500,000 and a gain of $500,000, making up that full $1 million. So if we take a look at the RRSP full $1 million is taxable. That will be considered income. That puts you into the highest tax bracket very quickly. And the result of all of that flowing through a personal tax cycle in one given year is probably about $550,000 being what ends up in your pocket. If we look at the non-registered million, again, half of that is already your own capital. You don't get taxed on that. You only get taxed on the growth. So if we're looking at the $500,000 of capital gain, there's a 50% inclusion rate to that. So half of the capital gain also isn't taxable. And of the $250,000 that would be on your tax return, the taxable amount on that is just a little over $80,000. So you're over $900,000 getting to your pocket. And in the corporation has many filters before it gets down to your personal spending. And the corporate account is often where people get tripped up. Even if the corporation's investments grew, getting money out to personal hands often means multiple tax considerations. The final spendable number probably ends up about $700,000, but varies because of corporate tax rules and having more moving parts. For the purposes of this video, let's keep the corporation fairly simple, fairly high level. If there's investment income within the corporation, that'll get taxed within its own tax structure. To bring those dollars out personally, there will be some refundable dividend tax on hand. Essentially, those are just nominal accounts that build up that once dividends are paid personally, those can be tapped into. The capital gain that we were talking about earlier with the corporation, the half that is not taxable goes into what's called a capital dividend account, or CDA, that can be a special filing to get those dollars out to personal hands tax-free. And that is why corporate results can vary from situation to situation. If you are planning a large withdrawal from a corporate account, please talk to a financial planner, an accountant, and coordinate that strategy. If you want a dedicated video talking about corporate strategies, leave a comment below. This is ultimately the root of a lot of different decisions that we go through as advisors going through your financial plan. Understanding that large withdrawals have a huge tax impact, and if that's the right decision for you. For those registered assets, dripping them out through time will result in a lot lower tax bill. For the corporation, understanding what needs need to be on the personal side to ensure that no large rash decisions are made. And for non-registered, trying to balance when those capital gains get triggered is a key point to having an effective financial plan. Thanks for watching. See you next time.